It's Monday, January 19th, 2026, and something just happened that most people won't understand until it's already too late. Copper is gone. Not down, not expensive, not temporarily tight. Gone. If you went to the world's largest online bullion dealer today, APMEX, a company that has dominated physical metals distribution for over 2 decades, you would not find a single copper bar or round available for purchase. No prices, no delivery estimates, no checkout button, just one phrase staring back at you. Out of stock, alert me. And that sentence should make your stomach tighten. Because this isn't happening during a crisis headline. This isn't happening during a recession announcement. This isn't happening after a war escalation. This is happening while the mainstream is still debating whether the economy is slowing or merely cooling. But here's the uncomfortable truth. Physical metals don't disappear quietly unless something underneath the system is breaking. Gold warned first, through record highs and central bank accumulation. Silver followed, exploding higher as industrial demand overwhelmed mint capacity. And now copper, the metal that quite literally powers modern civilization, has stepped onto the stage. This isn't a coincidence. This is a sequence. Because copper isn't emotional money like gold. It isn't a fear trade like silver. Copper is wiring. Copper is power. Copper is infrastructure. When copper vanishes, it means the system is no longer asking what something costs. It's asking whether it can get it at all. And once markets cross that psychological line, price stops being the controlling variable. Availability becomes everything. Today, I'm going to show you why this copper shortage didn't appear overnight. Why the price action you're seeing is not extended, not overbought, and not speculative. And why the forces pushing copper higher are the same forces that sent silver up over 130%. Only this time, the consequences are far bigger. Because silver can spike. But copper? Copper breaks things. Over the past 8 months, copper has surged from roughly $8,500 per metric ton to over $13,000. That's a 53% move in less than a year. And I need you to pause on that number. Because a 53% gain isn't impressive for meme stocks. It's not impressive for crypto. But for a market as deep, liquid, and globally essential as copper, that's borderline euphoric. Copper is not a speculative playground. This is a trillion-dollar industrial artery that normally moves slowly, methodically, almost boringly. When copper moves 5%, economists notice. When it moves 10%, manufacturers panic. When it moves 53% in 8 months, something structural has broken. This isn't money-chasing charts. This is demand overpowering supply in real time. And here's the part that should make you uneasy. This rally didn't happen during economic euphoria. It didn't happen during stimulus checks or growth booms. It happened while recession fears dominated headlines. Which means copper isn't rising because people feel optimistic. It's rising because they're afraid of not having it. That distinction matters, because optimism fades. Scarcity doesn't. And this is exactly why the move isn't finished. It's just beginning. In this breakdown, I'm going to walk you through exactly what's happening. We'll start with the numbers that most people haven't fully absorbed yet. Then we'll look at where all the copper is going, especially the AI sector. Then we'll examine why Amazon is now resorting to experimental mining just to secure supply. And finally, we'll connect this to tariffs, inventory hoarding, and why copper is no longer behaving like a normal commodity. By the end of this video, you'll understand why the copper shortage isn't coming. It's already here. The numbers that matter, let's start with the numbers, because without them, none of this makes sense. Over the past 8 months, copper has surged from roughly $8,500 per metric ton to over $13,000. That's a 53% move. On paper, that already looks impressive. But here's why this number actually matters. Copper is not a speculative asset. It doesn't move on excitement. It doesn't rally because of sentiment. Historically, copper is slow, heavy, methodical. It reflects economic activity after it happens, not before. So when copper rises more than 50% in less than a year, during a period where global growth headlines have been weak, manufacturing data has softened, and recession risks are still openly discussed, that move stops being bullish. It becomes diagnostic. It tells us the market is no longer pricing copper as a cycle. It's pricing copper as a shortage. And once a market transitions from cyclical pricing to scarcity pricing, the behavior changes completely. Because scarcity does not care about valuation. Scarcity only cares about access. Now here's the core problem. By 2040, the world is expected to require approximately 42 million tons of copper every single year. But global mine production is projected to peak around 33 million tons by 2030. That creates a structural gap of nearly 10 million tons annually. To understand how extreme that is, you need scale. That shortfall is equivalent to the entire annual copper production of Chile and Peru combined simply disappearing. Not slowing, not declining, vanishing. And the market isn't preparing for this gap gradually. Demand is arriving simultaneously from every direction at once. That's what makes this different from past cycles. Electric vehicles alone require roughly 83 kilograms of copper per vehicle, compared to just 23 kilograms in a traditional petrol car. That's nearly 4 times more copper per unit. With projections pointing toward 50 million EVs on the road by 2030, that translates into roughly 3 million additional tons of copper demand from automobiles alone. Not optional demand, mandated demand, because governments have already committed to electrification targets that cannot be rolled back quietly. Then there's power generation. Solar installations require 5 to 6 tons of copper per megawatt, compared to just 1.5 tons for coal. So even replacing existing energy capacity requires far more metal before expanding the grid at all. Defense modernization adds yet another layer. Radar systems, electrified vehicles, weapons platforms, secure communications. That contributes an estimated 1 to 2 million tons of additional copper demand. And all of this is happening before we even talk about artificial intelligence, which changes the equation entirely. Now contrast that explosive demand profile with supply reality. New copper mines require 15 to 20 years to permit, finance, and construct. Each project costs $5 to $10 billion. The Resolution Copper Project in Arizona has been stuck in permitting for over 15 years, without producing a single pound of metal. Meanwhile, where grades have been declining for decades. For every ton of copper mined today, only 0.5 to 0.7 tons are being discovered in new reserves. That means we are consuming copper faster than we are finding it. Even recycling, which is expected to double to roughly 10 million tons per year, only closes about 1/3 of the gap. In other words, even perfect recycling doesn't solve the problem. It merely slows the damage. This is why analysts are now discussing $20,000 per ton copper, not as a speculative fantasy, but as a price level required to ration demand. At those prices, EVs become thousands of dollars more expensive. Energy transitions, slow dramatically, climate targets come under strain. Copper doesn't just rise. It forces choices. And that brings us to the largest demand shock of all. AI, the copper black hole. Most people still believe copper demand is rising because of electric vehicles. That thinking is already outdated. The real driver now is electricity density, and nothing consumes electricity or copper like artificial intelligence. AI does not run on software alone. It runs on data centers. And data centers are copper machines. A single large hyperscale data center can require over 2,000 tons of copper, roughly 27 tons per megawatt of applied power. To put that in perspective, one 100 megawatt data center consumes as much electricity as 350,000 to 400,000 electric vehicles. That's not incremental demand. That's industrial scale load concentration. And this build-out is accelerating rapidly. In the United States alone, data center construction has doubled in just 2 years, according to international energy agencies. Globally, Amazon, Microsoft, Alphabet, and Meta are pouring tens of billions of dollars into infrastructure, not for future growth, but to avoid falling behind right now. Copper is embedded everywhere inside these facilities. In the wiring, in the bus bars, in the connectors, in the cooling systems, in the transmission lines feeding the grid. Even the hardware tells the same story. NVIDIA's GB200 server units contain thousands of copper cables, stretching several kilometers per rack. When hundreds of racks are installed together, copper consumption explodes. Major miners now estimate that copper demand from data centers alone will rise from roughly 500,000 tons per year today to nearly 3 million tons annually by 2050. That increase is equivalent to the output of 4 of the world's largest copper mines. built solely to support digital infrastructure. And here's the critical detail. AI demand has zero price sensitivity. These companies don't ask, is copper expensive? They ask, do we have enough to stay online? Which is why something extraordinary happened next. Amazon's desperate move when corporations can't secure supply through normal markets, they don't wait. They bypass them. Amazon Web Services recently became the first customer of a new copper extraction method using microorganisms to leach copper from low-grade ore. Not a mine expansion, not futures contracts, biological mining. Copper is being extracted from previously uneconomic sites in Arizona using bacteria because traditional mining cannot scale fast enough. AWS isn't doing this for sustainability branding. They're doing it because they need copper immediately. They're even supplying cloud computing and analytics to optimize the mining process itself. Think about what that implies. One of the largest technology companies on Earth is partnering with experimental mining technology just to secure physical copper. This is not normal corporate behavior. This is what scarcity looks like before the public notices. And while this is unfolding quietly, another force is distorting the market. Tariffs, hoarding, and global distortion. Copper recently surged past $13,000 per ton for the first time in history. Not because demand exploded overnight, but because metal is being rerouted. The threat of renewed U.S. import tariffs triggered a massive rush to ship copper into the United States. As a result, U.S. prices now trade at persistent premiums to the London Metal Exchange. That premium acts like a magnet. It pulls copper away from the rest of the world. Today, the United States holds roughly half of global exchange inventories, despite accounting for less than 10% of global demand. That imbalance is dangerous, because inventories outside the U.S. are now razor-thin. London spreads remain in backwardation, a classic signal of immediate physical tightness. Analysts at ING and UBS have warned that the system has very little buffer left. And supply shocks keep coming. Strikes in Chile, accidents in Indonesia, flooding in the Congo. Years of underinvestment mean there is no margin for error left. Which brings us full circle. Physical shortages. Silver overwhelming mints. Gold draining vaults. Copper disappearing quietly, long before headlines catch up. Silver and copper. The convergence now lets bring everything together. Because copper isn't rising in isolation. It's rising in the gravitational field of silver. Over the past year, silver delivered one of the most explosive moves in modern market history. A 137% surge between 2025 and 2026, its strongest run since the early 1980s. And that move wasn't speculative. It wasn't driven by retail mania. It was driven by industrial necessity. Solar panels, electric vehicles, AI data centers, high-efficiency electronics. Silver didn't rally because investors wanted it. It rallied because industry needed it. And that matters, because copper lives in the same ecosystem. Both metals sit at the heart of electrification. Both are essential conductors. Both face declining grades. Both require over a decade to bring new supply online. When silver exploded higher, it sent a signal across the entire industrial metals complex. Conductivity is scarce. That signal did two things simultaneously. First, it confirmed that green energy demand wasn't theoretical. It was real, immediate, and inelastic. Second, it triggered what markets call a sympathy rally. Investors began asking, if silver, a smaller, thinner market, can rise 137% under industrial pressure, what happens to copper, the metal required in far larger volumes? That's where the catch-up trade was born. Copper began attracting capital not as a speculation, but as a lagging necessity, a value play inside the same electrification storm. And unlike silver, copper doesn't just go into panels and chips. Copper builds the grid itself, which means copper demand doesn't peak with adoption. It accelerates with scale. There's also a deeper structural link. Much of the world's silver production is a byproduct of copper mining. So when copper supply tightens, silver supply tightens too. They are intertwined at the geological level. This creates what I call the double dip effect. Rising silver demand stresses copper mining. Rising copper demand constrains silver output. Both reinforce each other. And now look at the scoreboard. Silver, plus 137%, largest move in over 40 years. Copper, plus 36.7%, biggest annual gain since 2009. At the same time, global copper inventories are near multi-year lows. Analysts project a 304,000-ton refined copper deficit in 2025 to 2026, and that's before AI demand fully shows up in the data. This is why copper hasn't collapsed during market pullbacks. It has a floor built by silver's industrial demand. The silver rally didn't just lift prices. It reset expectations. It taught the market something dangerous. When electrification metals run out, price doesn't ration demand. Availability does. And copper is now next in line. Silver showed what happens when mints can't keep up. Copper will show what happens when civilization can't. Copper is no longer behaving like a normal industrial metal. It's being treated like infrastructure oxygen, something you secure first and price later. Gold warned of monetary stress. Silver exposed physical strain. And now copper is revealing the real bottleneck of the modern world. You can print money. You can write software. You can tokenize nearly anything. But you cannot print copper. And the system is starting to remember that. This isn't a short-term trade. This is a structural shift. And once the public understands why copper vanished from supply chains before it vanished from price charts, the repricing won't be gradual. It will be sudden.